Our second paper for this session is by Maximiliano San Millan from CEMFI.
Thank you very much. Let me start by thanking the organizers for inviting me to present at this conference. So let me start by giving you motivation about this paper. So it's motivated by what I consider first to be a bit of a paradox in my view. So it has been documented that rapid credit expansions in certain sectors in the economy, and in particular in the residential real estate sector, tends to be associated with a higher probability of future banking distress and with lower future GDP growth. Now, in spite of this fact, the design of our capital requirements is predominantly macroprudential, and because mortgages tend to be individually safer than other exposures, then we require banks to hold less capital against exposures in the real estate sector vis-a-vis other corporate exposures. Now, what I'm going to do in this paper is to study the macroprudential implications of this microprudential design. And I'm going to be looking at episodes of banking distress, and I'm going to study how different regulatory designs, in particular the type of buffers adopted after the Basel III reforms, so in concretely the countercyclical buffers and the proposal of sector-specific countercyclical buffers, can help at preventing and mitigating these banking distress episodes. And basically the contribution is a quantitative one. I built a two-sector DSG model with the structural credit risk, and where bank-level distortions, namely the presence of limited liability and deposit insurance, are going to play a role. So it's going. The mechanism is really going to be a risk-shifting type of mechanism. In case I run out of time, let me just say that the model will indeed predict that expansions in real estate credit is associated with lower future GDP growth. And in terms of the policy analysis, what I find is that increasing the levels of risk-sensitive capital requirements, for example, by adopting a capital conservation buffer, while it does reduce the probability of banking distress, by making bank capital scarcity considerations stronger, actually induces a larger reallocation of credit by banks towards the real estate sector, which is the sector with the lower risk weights, and that the stabilizing effectiveness of countercyclical buffers is enhanced by the adoption of sector-specific countercyclical buffers as opposed to the generic CCYB. And intuitively, what the sector-specific countercyclical buffers will do is to dynamically correct bank risk-shifting incentives in response to an increase in non-diversifiable risk in the economy, as I will explain next. So let me skip the literature in the interest of time. But basically, like I was saying before, the mechanism is one in which there are risk-shifting incentives motivated by the presence of limited liability and insured deposit funding. So in the model, I will assume that there is a non-diversifiable driver of returns, which means that in response to an increase in this type of non-diversifiable risks, banks will be willing to expand their balance sheet as much as possible, and the sector where they can do this more easily will be the sector with the lower capital charges, which is, of course, in this case, real mortgage lending. Okay, so the consequences will be that the looser lending standards associated with these lower capital requirements will lead to larger increases in borrower leverage and will amplify the small downturns in real estate markets. So that's basically the story. Let me give you a brief picture of the model. So basically, financial resources in the model finance one period risky ventures, which I call housing units and firms, So these are the final borrowers, if you want, in the model. And these borrowers are subject to both risks that can be diversified away by the banking sector and risks which cannot be diversified away. So that is why banks in each sector, both the mortgage and the corporate sector, are going to be subject to this non-diversifiable risk. The metaphor that is used in this literature is to describe this economy as one in which there are islands, and in each of these islands we have these banks, and they can diversify across the borrowers in their island, but they cannot diversify away the island-specific risk factors. So essentially what's going to happen in the model is that I'm going to be shocking the cross-sectional dispersion of this idiosyncratic risk, okay? Both at the diversifiable level and at the non-diversifiable level. So these are the shocks that I was mentioning before. There is this cross-sectional level of risk at the borrower level, and there is the island level risk, and I'm going to assume that on top of the traditional AR1 productivity shocks, we have the type of risk shocks that have been described before in the literature, which essentially will generate larger default. Now, as it happens, when I calibrate the model, it will be the case that the mortgage sector, will have a higher relative importance of the non-diversifiable component of risk. In other words, this is to say that in spite of the fact that you can have on average safer mortgages, the defaults in that sector will tend to be more correlated among themselves. So due to the risk-shifting incentives that I had described before, this will create incentives for banks to reallocate their portfolios towards that sector as we shock the economy with increases in non-diversifiable risk. The balance sheet of these banks consists basically of loans on their asset side and insured deposits and equity provided by bankers, and they are subject to capital requirements. Capital requirements I will later calibrate following the Basel IRB formulas, and they have, the next period, they will have some returns which will be affected by both the diversifiable and non-diversifiable components, but where importantly, banks will not dislike the non-diversifiable component of risk, as they will be protected by limited liability. These capital requirements will be binding in equilibrium given the distortions that I have described before. So essentially, how credit is going to be allocated in this economy is going to be more or less as follows. Banks will offer borrowers a menu of contracts such that bankers are properly compensated by the value of the equity that they invest in the banks. Now, because I will be assuming that bank net worth is scarce as is standard in this literature, there will be a shadow value of the banker's net worth. But more importantly, this participation constraint states it crucially depends on capital requirements. So essentially, lower, let me be more specific, let me say capital charges instead of capital requirements. So this is the effective equity cost per unit of lending that banks will face, and they will, higher capital requirements or higher capital charges will tighten this constraint in a manner such that if we think what's the way in which these loans are determined, well, borrowers see this participation constraint of the banks and they choose their leverage and a promised loan rate so that when we have tighter capital requirements, essentially the bank's participation constraint will become more binding, and in equilibrium, the borrower leverage will also be constrained. So far this is quite standard, but let me say what I do with this framework after I calibrate it to the euro area financial and real data for the period in which Basel II was in place. What I'm going to do now is to show you what happens when we introduce different types of buffers. Okay, so I calibrate the capital requirements. I assume that there is some partial adjustment, basically to capture the fact that some banks use through the cycle and other banks use point-in-time PDs. And I use the regulatory formulas in the Basel framework. So these are different regimes that I will analyze, where of course in Basel I we had basically non-risk sensitive capital buffers, and in Basel II we allowed the buffers to depend on risk parameters, and then in Basel III we add the buffers. So let me skip this. Let me just say in terms of the calibration that the model accommodates the data by setting a higher relative importance of non-diversifiable risk in the mortgage sector, which will be important. Okay, banking crisis that I will study are episodes where there are large costs to deposit insurance, so larger than 3% of GDP in a year. I want to understand what's going on in the path to a banking crisis, what's going on with real estate credit, what's going on with corporate credit, and what's going on with capital requirements. So I want to look at how this crisis look when I adopt different buffers, and I want to look at the outcomes in terms of the probability and severity of banking crisis. So this is a typical path to crisis in the model, where basically I'm comparing the baseline economy with a counterfactual economy, where I remove the risk weight and I set the capital charges to be constant, as you can see in the bottom panels. So what we can observe in this figure is that with the flat capital requirements, banks' incentives to reallocate their portfolios towards the real estate exposures is now smaller. So there is a smaller reallocation towards the more systemic sector. And this is essentially because we have removed artificially this difference between the requirements. Also, because of the lower reallocation in the corporate sector, we observe a smaller fall in GDP. Now, I mean, this is already interesting, but let's see what happens when we compare the baseline with the economy in which we add the capital conservation buffer. That is, we increase the capital requirement on risk-weighted assets by 2.5 percentage points. And actually, what's going on in this case is that we have increased the gap between the effective capital charges across the mortgages and the corporate credit. And this in turn leads to a sharper reallocation towards the mortgage sector in the path to crisis. So as you can see, the capital scarcity considerations are very important in the presence of these risk-shifting distortions. And finally, let us introduce the sector-specific and the generic countercyclical buffers, which I introduce with a smooth function because I'm basically solving the model using a third-order perturbation approach. And what I find in this case is that adopting a generic countercyclical buffer is not as effective as adopting the sector-specific, the sectoral targeted instrument. So what is going on in this particular exercise? So basically, all these crises are driven by increases in non-diversifiable risk. That is the main driver of the event. So because non-diversifiable risk is more important in the calibration in the real estate sector, banks have incentives to reallocate their portfolios towards the mortgage sector. However, once we allow capital requirements to adjust to credit growth in each individual segment, what we achieve is a dynamic correction in those incentives. That is why we can see in the green dotted lines in the figure that the reallocation towards real estate loans is much softer, and also that the subsequent fall in output is much more, well, maybe not much more. I'm working on a different calibration, but it's smaller. The output fall is smaller. And again, what we can see if we look at the difference in the effective capital charges is that countercyclical buffers are basically shrinking the difference between the effective capital charges in each sector. In terms of how the buffers do at preventing banking crisis, well, let me say that the capital conservation buffer of Basel III does a good job. So in the baseline calibration, this banking crisis happened 3% of the time annually. And basically, in Basel III, we are cutting that frequency to roughly half. But in terms of the output losses in the event of a crisis, then essentially the buffer that works best at cutting those output losses is the sectoral CCYB. Notice that perhaps I was surprised when I did this that it's important to aggressively relax the buffer on the corporate sector, as well as tightening the buffer on the real estate sector. So basically, that's the main result. Sectoral countercyclical buffers can be effective tools. Let me just conclude in order to keep with the time. So the key message I think of this point is that of this paper is that increasing just the level of risk-sensitive capital requirements can lead to more severe reallocation episodes, in the sense that bank capital, the scarcity of bank capital can become more important. And in contrast, if we also allow for a dynamic approach in which there is a timely correction of the distortions by perhaps reducing the differences in effective capital charges by adopting the sector-specific type of buffers, we can achieve large stabilization gains. And going back perhaps to the initial motivation of the paper, I think that one final message is that the macroprudential design of bank capital requirements can indeed exacerbate the reallocation of credit towards real estate in the build-up of vulnerabilities in the financial sector. Okay, so let me stop here.
Thank you. So discussing this paper is Pedro Guete from a university.
So thank you very much first to the organizers of the conference for inviting me to discuss the paper. It's a very nice paper and creative. I have to say I like it a lot because it gives an opportunity to think on the two reasons for this conference, right? Because this conference is called Financial Stability, and after up to the financial crisis, it was a micro conference because basically financial stability was macroprudential regulation. After the crisis, the financial crisis, then we start having this new word, macroprudential regulation, and now the conference, probably Rafa, Angel, they struggle to put papers on both dimensions, and I like this paper because it creates an opportunity for a shock between the two. Okay, so the first I'm going to classify what I call macroprudential, and I found this figure in the New York Times that I found super cool, because to me the sufficient statistic of macroprudential is basically bank failures. That's kind of the variable I think is key to measure the classical banking regulation. Well, when you see this, you notice that at least in the US, supervision, it made some mistakes, right? It's kind of, we had previously here Jay Powell, but when you see that the level of 2023 is kind of, in terms of, you see the billions of dollars there. So this is showing you this macroprudential approach, but something I found interesting is that even if you notice that, look, really we had a big banking crisis, the macroprudential approach is going to be different. And when you think on the banking regulation, the micro approach, you see there are two key variables, right? One is the probability of default, the other is the loss given default. This is kind of the two classical variables. And if I was checking the Basel framework, how to compute capital requirements, and when you go through all the formulas, you see formulas like this in which there are many other variables, but you always see this LGD, loss given default, probability of default. There are different ways to compute the risk-weighted assets, but this is the interesting thing of this macroprudential approach, is that these two are these key elements, and real estate in these two elements is kind of a safe type of credit. Okay? But when you go to macroprudential, that to me the sufficient statistic is house prices. That's the key variable that macroprudential regulators, I think, need to keep tracking. In fact, if you follow what happened during the financial crisis, you see this big drop in house prices. Recently, we didn't have any big change in house prices. That's why I think the recent banking crisis of the US so far didn't go so much into the economy. Okay, but what you see is that real estate sector is key on the macroprudential. This is another set of very nice pictures. The previous was the New York Times. This is Yale. Yale have a web page where you find, in my opinion, the best pictures of the financial crisis, house prices. This is the evolution of types of credit that you see at all the crisis was basically mortgage debt. And these ones that get super sophisticated but super cool. All the things that the US government had to do, okay, during the global financial crisis. You have here this measure of the LIBOR OIS stress in the system, okay, and you notice that this is basically, I think this figure created macroprudential regulation. It was obvious after this crisis that we have to change the approach to financial stability, and this created that part. And now coming back to, and then you start having all these new words, that is what creates macroprudential, right? It's fire sales externalities, collateral externalities, financial accelerators, bubbles, and housing real estate is key on this. Okay, it's an asset that is behind. You have the papers of Jacobello, all this literature in which, but real estate was before, I'm pretty sure 20 years ago, I don't know, in this conference, before the financial crisis, there were very few papers on real estate in this conference. Now I'm sure that the past years, real estate has become a mainstream of the conference. And then going back to the paper, I think what is a great insight of Max, I'm going to shorten your name, okay, of Max, is that he says, look, there are two things here going in opposite directions. Real estate credit defaults usually less. In case of default, the losses given default are smaller because, for example, foreclosure is not the same than a company. Assets of companies are much more specific, so if you close the company, it's harder to sell, but you foreclose on a house and you sell the house. So what it happens is that from the micro perspective, the real estate credit ends up having a better treatment than the corporate credit. But at the same time, like the previous picture showed, real estate is at the center of all the macroprudential risk. And then I went to look in the data, And there is this very nice paper from the Central Bank of Ireland, I don't know if anybody is here from there, in which basically they took all the different types of credit in the economy, and they tried to compute what's kind of the capital weight that they applied. And unfortunately here we don't have a big screen to highlight, but if you see the NFC, this is the non-financial credit, then you see the mortgages next to it, and you can see the numbers, right? Is between 51% and 31%. And I think this was the brilliant idea of Max, is to see the macroprudential approach treats real estate in a beneficial way, when in the macroprudential is kind of probably the enemy you have to control. Okay, and then Gallo gave 3 comments. I'm going to put 5 comments here. Okay, so the first is that, now going back to his paper, I tell you, I think it's a very brilliant idea. The first thing is that the paper, I think, has to clarify much more how the model is working. It's a complex model, and I think we need to have input response analysis to understand very well the propagation mechanism. And then real estate, it's complicated because now we notice that it's the collateral to many things, especially also for corporate credit. We have a new literature here. There are different papers on this showing that it matters for companies, for entrepreneurs, for many things. And this is telling you that it's not going to be clear, okay, when you model the value of housing, because it matters for both. Housing, that has wealth effects, many other effects, but also for corporate. And I think it's going to be key that you model different ways to see how your results depend. The second one is that Max spends some time on the calibration. I think when you take on this paper, that paper that came to my mind, and these papers I didn't see them in your paper, that's why I put them here, is there is a new literature studying the crowding out from real estate towards commercial. And if you see papers like this one of Chakraborty, they have these very nice input responses in house prices, how they change credit in corporates. I think this paper is kind of a DSG model. It should be calibrated with matching input response analysis, something like that, to match this. I think that will make the paper very credible, because I think at this moment, credibility of the quantitative, we have a million ways to calibrate, and depending on what the governor of your bank tells you, you can get one result or the other. But if you match these kind of figures, I think you get more credible. Then the paper is focused, and it's really a paper focused on minimizing crisis. All the paper is, you see, evaluation of Basel III, and if you see the x-axis is, do you have a banking crisis, what happens before or not? And I understand that regulators, usually you never get credit for the crisis that didn't happen, but I think we need to have, since I'm in academia, I think we need to do analysis out of crisis to evaluate regulations. We need to compare GDP, and maybe some crises are healthy in capitalist economies. I don't think it's good to minimize all the crises, because we know how to minimize crises. In some Soviet countries, they don't have so many crises, but there is a price on growth. I have a paper on this. So I would push much more to do this analysis of regulation out of banking crisis versus minimizing banking crisis. At least the focus on the paper. Okay, then to me, when you think of macroprudential of housing markets, now the key variable is LTV regulation. There is this very nice paper of Benetton in the Journal of Finance showing that there are relations between loan-to-value and capital requirements. And here you have the first paper. I have some kind of general equilibrium to study these things. And I think maybe macroprudential regulators, they need to know these 2 tools, right? You have a new tool in the army that before you didn't have, LTVs. And then you have the capital requirements. And maybe you don't want to operate through capital requirements, and you want to operate through loan-to-value. And I think maybe you can contribute to this. That seems to me a very interesting question. And then to conclude, okay, we have here in the Bank of Spain, Sergio and Rodriguez Monero and Raschedi was here. And something very important when you take, especially for policymakers, is the role of appraisers. And I think this in Spain has been very important topic, is that basically what happens is that all these regulations that depends on the value you assign to the house, if you change the value of the house, this has implications also for the capital requirements that the banks have to have. Okay? And in these papers, they show this. The Spanish banks, by having maybe distorted appraisers, distorted valuations, well, maybe they have been savings on the capital they need to have. And I think this for regulators is a first order. Maybe in the US, appraisers are much more strict. I think this depends on the countries, but at least I guess, especially in southern Mediterranean countries, in which sometimes things are more tricky. I don't think this should be in your paper, but since this is a policy conference, I thought that this was very important to think, because this paper shows it there. You see this kink, okay, on how appraisers behave, and I think that's very important. So to conclude, is like I found this paper very creative. I think it's a very promising paper. It's still You see, Max is still a very young guy, has time to write this paper, maybe more papers. I wanted to give you ideas, and I enjoyed. So thank you for the paper.
Thank you. Max, you want to take a time to answer?
Yes, thank you. Well, thank you. I have only words of gratitude towards this very constructive comments. Maybe a few comments on what you said. You mentioned the complementarity between real estate and corporate credit. I think that it is indeed. I think it is indeed crucial. Actually, well, the paper is calibrated using residential mortgages, but we know from the experience in Spain that commercial real estate credit also had a major role during the crisis. So exploring a different approach, or perhaps a different strategy in the calibration that would allow me to also include the role of collateral in the corporate sector would be very important. And then you mentioned loan-to-value regulations. This is something that this is a comment that I have received before, and that is, I mean, I think we don't have right now a framework that allows us to study simultaneously capital requirements and borrower-based measures in the same analytical framework, and I think that would be a great contribution for the future. So, thank you.
Thank you. So we open now the floor to questions.
Thank you, Max. Super interesting paper. Two questions. One is, I think, not so much about the paper, but I would like to pick your brain on it, is how much of this, sort of high fat tail is a structure of the housing market, or is a decision of banks? So let me put it in other ways. Could it be that if I lend to intermediate loan to income or intermediate loan to value, then I wouldn't have this sort of fat tail that you model? That would be one question. Or do you think that there's no way around this? This is a structural feature of the housing market that's always going to be subject to that problem. Because I think this then has effects on what you want to analyze. And then I catch something that I hadn't seen before, and I would like you to comment on, if possible, that is the effect that this has on housing default, on borrower default. It looked like there was, maybe I skipped, or maybe I didn't see it correctly, but it looked like in your proposed better measure, the sectoral countercyclical capital, it looks like there's a boost in the default. It goes from 0.81 to 1%, but maybe I'm wrong. So if there's something that happens there in the default, why am I saying this? Because if you're thinking about a welfare type of model, which I think you've been pushed to that, and I think it's a good thing, then this cost can be a very big cost to take into account. If this is affecting, households' default in some way, then yes, you have a safer banking industry. That's great. The model is tailored for that. But if I'm pushing 25% more of the households into default, then maybe I'm having some problems there that are something to take into account.
Okay. So if you want to answer.
Okay. Thank you for your questions, David. So, in terms of the risk characteristics of the real estate sector, I think that's a great question. I don't have I think I don't have a good answer, but if you think about the corporate sector, then you have different industries. You have diversification there in an extent that maybe in the real estate sector, in the end, it's still housing, no? So it's still one sector. So I would tend to think that there are still some inherent features of the sector that make defaults there more correlated when they materialize. As to the second point. Well, yes, you mentioned that under different regimes there may be different average probabilities of default. This may be a consequence of one of the figures that I was showing before. In the sense of how leverage is determined in the optimal contract. It may be the case that yes, okay. So it may be the case that you have safer banks due to the higher capital requirements, and still you have some riskier borrowers. That can happen. That can happen in the model. Whether it is, I have some preliminary welfare numbers. There are still very small welfare gains if you move from one regime to the other, but there are bankruptcy costs that would be associated with housing default that would be higher under that regime. Yeah. Okay.
Well, thank you.